Buy once, hold forever. And just like that, your money works harder than you do. Sounds like one of those fake guru promises, right? In a world obsessed with flipping NFTs and trading options, there's still a simple investing strategy that refuses to die. It's called buying great companies and doing absolutely nothing afterward. And strangely, it works really, really well. This is the actual strategy used by billionaires like Warren Buffett. Find a company you love that's well-run, profitable, and has room to grow. The real magic? It's in what you don't have to do. Once you've got a solid company in your corner, you stop thinking like a trader and start thinking like an owner. Every time you sell a stock, Uncle Sam's standing by with his hand out. But if you hold forever, you skip all those capital gains taxes. Back in the day, you had to deal with trading fees, commissions. These days, it's basically free. Let the math of compounding quietly turn your $100 into $1,000. No drama, just smart ownership and time doing all the heavy lifting. Buffett didn't get rich chasing meme stocks. He got rich buying greatness and refusing to let it go. This strategy isn't perfect for every investor. Sometimes it's not the way. I don't follow the strict buy and hold doctrine because most of my investing happens inside retirement accounts. I focus on high-yield stocks, not flashy tech darlings. Reliable, modest growth companies that pay out juicy dividends are my targets. These stocks are easier to value. Their business models are stable and payouts predictable, allowing for capital recycling. Instead of 8 to 12% annual returns, I've pushed that closer to 12 to 20%. I'm not playing stock psychic, just looking for value mismatches. Think of it like buying ripe fruit and selling before it spoils. Rinse and repeat to maximize profits. Buy and hold is still effective, especially for taxable accounts. Skip the capital gains drama. Let your winners ride. If you have a tax-free account, you can adopt a more active tactical strategy to grow your money without getting burned. I'm just saying, sometimes, depending on where your money lives, playing the field can pay off way more than sitting in the bleachers forever. Buy and hold is great, but a little tactical finesse can boost returns. What if there's a third option? Enter dividend growth stocks. When I say dividend growth, I'm not talking about monster yield traps that collapse. I mean businesses paying 3% or more with annual growth. These companies pay respectable yields and grow payments like clockwork every year. They provide steady income and appreciation. Dividend growth stocks are the unsung heroes of portfolio building. They offer what most investors want: income plus appreciation. This strategy works whether you're in a taxable account or a retirement one. A 3 to 4% yield gets you started for income you can live off of. If that company's increasing its dividend by 10 to 12% a year, in 10 years, your yield on cost could be astonishing. It's the kind of investing that feels calm, but is actually quietly aggressive. You're not flipping anything or timing the market. You're just holding companies that grow, and they're paying you more and more to hold them. It's wealth building disguised as patience. After a decade, your income from that position has basically doubled or tripled without you doing anything. Dividend growth stocks don't need to dominate headlines or break the internet. They just need to keep showing up quietly every quarter. So if buy and hold is the vehicle, dividend growth stocks are the luxury model. Smooth ride, steady power, reliable over the long haul. They don't just help you get rich, they help you stay rich with income that gets better the longer you wait. Now let's talk about the real MVPs of this dividend growth game. alternative asset managers. Firms like Blackstone and Brookfield Asset Management are doing something most companies wish they could do: making money hand over fist. These companies manage massive piles of money for pension funds and very wealthy people who like their income streams as smooth as their scotch. What makes them special isn't just the scale, it's how they earn their keep. Unlike traditional asset managers, alternative asset managers don't rely on public market craziness to make money. Their funds are often private and much stickier. When someone hands over capital, it's locked in. This means the firm collects fees like clockwork, regardless of stock market fluctuations. These firms earn not only management fees, but also performance fees, receiving a slice of profits when investments outperform expectations. They invest in energy, real estate, infrastructure, credit, and private equity, accessing investment opportunities not available to the average investor. Alternative asset managers follow an asset-light business model, focusing on smart management without heavy capital expenses, leading to high profitability. For shareholders, this means steady dividend payouts and extra cash available for reinvestment or returns. It's the financial version of being in shape without stepping foot in a gym. High returns, low effort, thanks to capital diversification. Owning shares in Blackstone or Brookfield is like having a custom-built index fund boosted with performance steroids. These firms are not just about stocks. They manage the machinery behind massive global deals. They're powerful and profitable, engineered for patient investors with increasing payouts year after year. The economy is rigged in their favor. With infrastructure crumbling, private capital steps in where governments can't. Blackstone and Brookfield are deep in billion-dollar infrastructure projects for stable returns on necessary assets. The world's transitioning to renewables, and while that's great news for the planet, it's also a logistical and financial beast. Solar farms, wind turbines, smart grids, all of it takes investment. And who's throwing down the capital? Alternative asset managers again. Brookfield, in particular, is basically becoming the Beyoncé of green energy. Quietly everywhere, undeniably dominant. Maybe the least sexy sounding part of finance, but also one of the fastest growing. As banks get stricter with lending, companies still need money, right? So private lenders fill the gap. Oh, and let's not forget about AI. Behind every new AI chip, every hyperscale data center, there's money, tons of it. Brookfield has its hands all over this, with data center investments that support the AI explosion behind the scenes. These aren't moonshot bets. These are carefully calculated plays on megatrends with decades of runway. These firms are out there shaping the market, placing long-term bets globally on housing, healthcare, and high-tech. Buying into Blackstone or Brookfield means investing in global essential trends that lead to compounding dividends. You're not gambling. You're participating in the trillion-dollar shifts that are happening now, without high-risk startups. Brookfield's dividend yield is often around 3 to 4%, a modest start, but leads to consistent double-digit growth over time. Long-haul wealth building means patience as modest yields evolve into a robust stream of income in the future. You've got Stephen Schwartzman at Blackstone and Bruce Flatt at Brookfield, two guys who've built massive investment machines without chasing trends. These aren't hype CEOs, they're execution machines. Plus, they both keep balance sheets tighter than a drum. Strong credit ratings, tons of liquidity, no reckless spending. They grow when it makes sense and play chess while half the market is playing Candy Crush. When you're holding these stocks, you're not just hoping for price action. You're getting paid while you wait. Dividends roll in quarter after quarter, and over time, those payouts don't just grow, they snowball. When someone asks about your investments, saying Blackstone and Brookfield is not just a flex, it's a strategy. To lock in a solid dividend game plan, pair SCHD with Blackstone and Brookfield for stability and growth. SCHD offers broad, stable exposure to U.S. dividend stars, while BX and BAM drive growth and income. Think of SCHD as your rhythm section, keeping things smooth, while Blackstone and Brookfield excel with high-performance payouts. If this clears up what buy and hold forever means, hit that like button and drop your favorite dividend stock in the comments. Thanks for hanging out. See you in the next one.